Hey everyone, it's Jay Soloff. I'm an option coach here at NetPicks, and I'm going to show you how to trade the options wheel strategy. So I'm here at Market Chameleon, marketchameleon.com. I'm looking at the analytics that the site is given on trading options. So we're looking at the options chain for GM, General Motors. I'm an old school company, but still pretty good for trading options, and something like the wheel strategy works really well. Now, wheel strategy works really well for a lot of different stocks, but generally speaking, you're looking for something sideways to bullish, range bound, going up slowly. Even going up quickly is okay, but keep in mind there's a limit when we're going to, also I'll show you here, when you're selling puts and doing cover calls, which is all the wheel really is, right? There's a cap on how much money you can make on the upside. So you have a stock that is going straight up, probably just buy the stock, buy calls. If stock's going straight down, buy puts, stay out of it, etc. But during normal times, stocks tend to be range bound or go up slowly, and that's where the wheel strategy really shines. So here we are, GM. It's trading about 58.50. So let's say we're going to go a month out. This is close, 29 calendar days. That's perfect. It's about 30 days out. So let's say we want to start by selling a cash secured put. All that means is you need to have the cash in your account at whatever strike you sell the put at. So if it goes down, you end up buying 100 shares. So you need at least 100 times the strike price. So if we sell the 55, you need $5,500. Let's go up here actually to the 57. All right. Let's say we want to be somewhat aggressive, sell something pretty close to the money because we don't mind if it goes down, we end up getting assigned. The benefit of that is we're getting over $1, almost 2% to sell this put, right? It's only 2.5% from where we are right now at 58.50, but we're also picking up about 2% on our cash secured put. That also means that you don't start losing money on it until it goes down below 56. But again, we don't mind because the wheel is a multi-part strategy, right? So let's say here, stock's at 58.50. We sell the 57 put. It looks something like this, right? You make money anywhere above your strike price, below you have about $1 cushion, and then it's just like owning the stock, right? Okay, so let's say it does go down. Let's say it goes down to 56. All right, now we're break even because we collected $100 and the stock's at 56. When we own the stock, we get assigned. Broker takes care of that. Now we own 100 shares at 57. So we're break even, but now we own the shares, and now we're in a position to sell a call. And let's say, we want to sell a call $2 above, so at that point, it's September 26th. So we go out to whatever the closest to 30 days out is. But just to keep the pricing a little bit more accurate, let's just say we now own the shares now, and we wanted to go up about $2. So we collect again, probably another, a little over $1. Right? A little over, something around 2% to sell the call. Again, we'd own the shares at 57, but just to keep the pricing accurate, let's say that would, if it was at 57, we own the shares at 57, the stock's at 56, we'd be selling the 58. But because I want to keep the pricing more accurate, we're going to go up and we're going to pretend that $2 above the stock price is 60 and we own the shares at 58. So we would sell a call, right? And because we own the shares, we put that in there. Now we own 100 shares, we sold the call, and it looks something like this. So now we make premium, and we can make money on the stock up to our short strike. So we can make $200 on the price going up of the stock from 58 to 60, or, in the theoretical example, 56 to 58, right? Plus the $100 in premium. So you can make up to $300, and then it's capped. Again, if it goes down, you have some cushion, but it's just like owning the stock. So what's great about this is that it's generally not going to happen like this. First, you're going to sell, let's say and this is fine, right? Because you've made money. You've made $100 on the puts. You've made $100 on the calls roughly, and $200. So you've made $400 on, and you put down 5,700, right? So real quick, just doing the math in that situation, that's over, let's say, a 2-month period. You've made $400 and you put down 5,700. That's 7%. So in a 2-month period, you made 7%. You think about that annualized, right? That's 42%. Right. So you're doing better than the market in just about every single year ever. Right. So not saying that the prices would be the same and that would change and that would happen every 2 months, but just in theory, think about that. Right. You didn't do all that much and you made 7% in 2 months. All right. But what's probably going to happen is that you'll get a chance to do a few puts and a few calls before any shares get assigned or called away. So let's say you sell 57, stock goes up to say 59. You make that $100. And let's say you sell, okay, and I'm going to sell the 58s a month later. Let's say you make another $100. All right, then it drops down, you get assigned. Then you sell a call and the stock stays there. And you collect $100 and then you sell another call, maybe another strike closer, collect another $100. Then maybe it goes up, you can get called away. And you've made, I don't know, an extra $300. And then maybe you sell another put and get back in. So you can see why it's called the wheel. You just keep cycling and you keep pulling in money. And even if it moves against you at some point, you're continually bringing in income and you have the chance to make money on the upside if you do get assigned. So it's a really great strategy for consistency and bringing in income. And over time, it really works wonders. And you don't even need that much time. I say over time, but this is still a shorter term trade, right? You're doing this in terms of months, months at a time, right? Not years. So it's a really good short-term strategy to make money and pull in income on a regular basis. The consistency is really what's so valuable about the wheel. All right. So this is Jay Saul from NetPicks, and this is how to trade the options wheel.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.